Subscribe to our YouTube channel and press the bell icon to get the latest updates.
I'm sure you must have come across images like this from China in the early days of COVID pandemic. Here, a Chinese security officer is staring at the screen displaying infrared images. The images are of people passing through the gate of a busy railway station. This was just a few weeks after the COVID-19 cases peaked in China. The officer's job was to keep a watch on the body temperature of all people passing through the gate. Of course, several people were doing it simultaneously. So how did the officer check everyone's body temperature without stopping anyone? Unique technologies in the thermal scanners were believed to be China's weapon to contain the spread of COVID-19 pandemic in 2020. China apparently succeeded in flattening the virus curve early with technologies like artificial intelligence and Internet of Things. This encouraged medical authorities in South Korea and the US too to try them in fighting the pandemic. But countries like China, the US and Korea are not the only ones to identify and exploit breakout technologies at such crucial times. In India too, several tech startups showed their mettle in the pandemic phase. Most were backed by venture capitalists or VCs who had been funding the research attempts for a few years. Hi, I'm Tanushree Banerjee, editor of Equitymaster's blue chip recommendation service, Stock Select. Welcome to Safe Stocks, where we discuss ideas to create and preserve wealth in the safest businesses. If you haven't subscribed to the Equitymaster YouTube channel yet, please do so and click on the bell icon to get notifications for my latest videos. Now, the VC culture may be new to India, but there is one VC that has backed tech innovations for decades. It was the late 1970s. Tech startups were mushrooming at Silicon Valley. A couple of Indian students and professors at MIT got together. They founded a tech startup to build a mini supercomputer. It was no ordinary device, but one to facilitate multiple processes and communicate over a common platform, a first in the world. Soon the startup was short of R&D funds and was on the verge of shutting down. The Tata Group, quick to spot early opportunities, became a venture capitalist in the supercomputer project. The company was renamed to Tata Elxsi and shifted to Bengaluru. Elxsi stands for Electronics and System Integration. A large part of its early years involved product designs which consumers could feel, touch and see physically. The high-end workstations were the best in the world for industrial design and animation. Since 1992, Tata Elxsi focused on three high-growth sectors: media, telecom and automotive. What differentiated Tata Elxsi from other tech companies was that it had design as its core. In a typical project, design is not more than 5 to 6% of the volume of technological work. But the ability to offer customized design allowed Tata Elxsi to command premium pricing. With a clientele spread across the world, 90% of the company's technology solutions are delivered abroad. In India, Tata Elxsi caters to the most tech-savvy MNCs and cash-rich businesses. This in turn has kept Tata Elxsi a cash-rich, debt-free, high-margin business despite the vagaries of the pandemic. The stock has been one of the most resilient even when other tech companies succumbed to the overall global tech sell-off in late 2021. The Tata Group may have multiplied their investment in the company 233 times since 2002. Of course, every business comes with some degree of risk, and all technology stocks are subject to massive execution risks. The thing to remember is that you need to be extremely selective and careful with such stocks. Startups especially have their own risks. They may have no profits to show for years. They may be dependent on debt, etc. So, can there be a low-risk option of buying startups? Let me tell you something. Just as you and I are keen to get invested in high-potential startups, so are large corporates. Turns out that some very well-run blue chips have already taken the next step of finding startups that suit the megatrends they wish to ride and have been buying stakes in them. And there is no denying that these large corporates can do far better due diligence of the startups, especially from the technology and R&D perspective, than we as individual investors can do. Now, most listed companies are linear growth companies. Very few of them have the potential to grow fast like startups. But something has changed over the last few years. Some forward-thinking listed companies are either investing in disruptive technologies or are acquiring fast-growing startups. They are incubating startups or riding startups at early stages. This picture will give you a rough idea of what's happening beneath the surface. This is a simplified version of what actually occurs. In reality, this maze of interconnections is much wider and deeper. However, once you decode this maze, a whole new world opens to you. You start seeing opportunities that are invisible to others. You start spotting companies that are turning from linear to exponential growth opportunities. Large business houses such as Tata's, Wipro, Marico, RPG, Mahindra's, Aditya Birla Group, Unilever, Info Edge, and the Hero Group have made significant investments in startups across emerging sectors, both at the promoter and the corporate level. Take the case of FMCG major Marico. It has invested in startups like Beardo and Just Herbs for strategic reasons. The Tata Group has invested in defense and semiconductor startups. Info Edge is anyways known to be a startup investing hub. And do not make the mistake of believing that only technology or service companies are buying into startups. Manufacturing companies are now becoming tech-savvy by partnering with emerging technologies in the startup space. Access to emerging technologies is a big factor that encourages large companies to partner with startups. While these conglomerates have the financial muscle to fund innovation, they find it easy and economical to partner with a smaller company that has already perfected the approach. Why reinvent the wheel when it has already been perfected by a nimble startup? A few of the companies have created venture capital-like structures to invest in new age startups. These venture capital funds are seeded by a dedicated investment pool from the company's own balance sheet. Now, if a large company is contributing to the fund, the company's shareholders get to partake of the gains arising out of these investments. And like InfoEdge shareholders did in the case of Zomato IPO, the shareholders of the parent company can see their wealth multiplying as and when the startups get listed. But can we blindly go ahead and invest in a listed stock that takes stakes in startups? Absolutely not. Despite their allure, many such startups can turn out to be extremely dangerous unless you're discerning about the cash flows, the addressable market, operating margins, and a lot more. So, taking indirect exposure to startups through large companies that are investing in them is one of the safest ways to buy unlisted stocks. But be wary of companies and startups that do not allocate their capital well. Hope you like this video. Stay tuned for more such videos on the safest and most appealing permanent wealth creating stocks. Thanks for watching.